You have said now to Congress that we are back at war. How long do you expect this to take? And what's the legal
Take
basis?
what? Take what?
The war.
Well, I think it's going very fast. We've demolished their military. We're hitting them very hard. And we had a deal yesterday or the day before yesterday. It was all done. And then they broke up that deal immediately because they found out there was something in the deal they didn't like. And they're wired differently, and we're not going to put up with it. We are just going forward. We're attacking them tonight. We're taking out all of their capability for anything having to do with the Strait, with the Hormuz Strait. And I think in the end, we will end up just controlling the whole thing.
President Trump says his war on Iran is back on and oil prices are extending gains. The latest wave of attacks dashing hopes for safe passage through the Strait of Hormuz. Live from Sydney, I'm Heidi Stroud-Watts. This is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. The president is now demanding a 20% transit fee for ships transiting through Hormuz under US protection. That adds up to about $38 million for a full supertanker. We'll be speaking with Jennifer Parker of UNSW Canberra about the flare-up in hostilities, maritime law, what Trump's strategy could mean for shipping security. Markets, meanwhile, bracing for that Hormuz shock with supply risks threatening inflation outlooks and reviving rate hike bets. And India's June inflation comes in above the central bank's target, even as foreign funds rush back into Indian equities, especially those large caps. We'll have more on what's driving interest. Get straight to our top story today. And US military forces say they have completed the latest wave of strikes against Iran aimed at degrading its ability to attack commercial shipping. Earlier, President Trump reinstated the US blockade of Iranian ships transiting the Strait of Hormuz and demanded that 20% reimbursement for all other cargo shipped through it. Ahead of today's military operations, he also said that the US would be taking control of the waterway.
We're attacking them tonight. We're taking out all of their capability for anything having to do with the Strait, with the Hormuz Strait. And I think in the end, we will end up just controlling the whole thing.
For more, let's get to Dubai. And our Middle East correspondent, Abir Abu Omar, joins us with the latest. And Abir, it's back on. The question is, which path does this take, right? How long lasting will this latest iteration of this war be?
Yeah, good morning, Heidi. A sense of deja vu really this morning, because I feel like we're repeating patterns that we saw yesterday and throughout the past couple of months, really. Whenever these tit-for-tat attacks happen, the retaliation takes similar shapes. And so just moments ago, we heard from Central Command by the United States saying that they finalized the latest round of strikes against Iran. You just saw on the screen there what areas in Iran were targeted. And those are similar areas since the U.S. has been attacking Iran over the past couple of months or so. The areas that it attacked yesterday or overnight are pretty much the same. Bushehr, we're seeing Shah Bahar as well. So some provinces in the southern part of the country. Iran retaliating against countries in the region. That includes Kuwait, the usual suspects really, Bahrain, Jordan. We're also seeing that yesterday Iran had attacked 2 UAE flagged ships in the Strait of Hormuz, leading to one person being killed and several others being injured. That's the Defense Ministry by the United Arab Emirates citing those numbers. And so where does this all leave the technical talks? The short answer is we just don't know yet. As of now, we do expect a return to these technical talks. We don't have a time or a date set out for them. They were already suspended for the mass funeral of the late Supreme Leader, Heidi, that ended last week. President Trump, in the meeting that he had with reporters at the White House yesterday, where he said that he's going to hit hit Iran hard yesterday and today and into tomorrow. He also said that a deal was possible. So it's quite surprising that you're still seeing those caveats come through, that the U.S. hits Iran, it hits them hard, as President Trump says, but then we're also citing a return to the negotiations. It's just important to note that we don't have a clarity on when or where those will happen. We also don't have clarity from the mediators, that's Qatar and Pakistan, about when or where those talks are set to recommence. But what we know for the time being is that the Strait of Hormuz, the movement there is quite limited, and it's having a major impact on Brent crude prices at $85 a barrel. That's the highest level we've seen in about a month.
It's just fascinating, isn't it? It's been, about 3 weeks barely since we've had the interim peace agreement signed. It's been about 1,000 days of this war this year. I do wonder this kind of punt that the president is making in terms of making this all about the Strait of Hormuz. The Iranians don't seem to be that keen to give up its control or its management of the strait.
No, not at all. You're right. I mean, President Trump said that the U.S. will now take a stance of being a guardian over the Strait of Hormuz, and that it will instate this 20% fee on all other cargoes aside from Iranian ones, because according to him, Iranian cargoes are now going to be prone to a new blockade. So we're returning to a state of a blockade in the Strait of Hormuz on Iranian ports. So pretty much back to... It's not fair to say square one, really, Heidi, because we're not seeing a return to March kinetic level of warfare where the entire region is dragged into strikes back and forth. But we're returning to a place that we didn't think we would be at, especially since you mentioned that MOU that was signed in Switzerland about three and a half weeks ago. President Trump saying this blockade will be reinstated, this 20% fee, so an escalation there as well. It would be interesting to see what ship owners are going to do with that. Our story cite that a lot of ship owners have been blindsided by this, but are still unaware of how they're going to maneuver around this new regime. And from the Iranian side, Abbas Araghchi, the foreign minister, says that Iran will continue to be the guardian of the Strait of Hormuz forever. This is on an X post. So again, tit for tat, Heidi.
Bloomberg Middle East correspondent Abir Abu Omar there in Dubai with the latest. And let's take a closer look at the crude market side of the situation, because President Trump's demand of a 20% reimbursement on cargo shipped through the Strait of Hormuz would mean a fee of around $30 million on a single supertanker full of oil. So let's bring in more from our oil trading reporter, Ron. So talk us through the numbers here and what are the implications, because we did see Iran manage to ship, by some accounts, an extraordinary amount of crude during that brief gap when they were able to.
Right, so with the latest developments happening at the Gulf, of course, one of the new developments, Heidi, like you mentioned, is that the blockade of Iranian barrels, it has been reinstated. But of course, during the time in between blockades, Iran has successfully pushed out over 50 million barrels of oil. But here's where we stand in terms of where these barrels of oil are going. So in light of sanctions, even despite an earlier waiver, which was, of course, it has been walked back on for mainstream crude buyers by the US, there haven't been much appetite for Iranian barrels. Now, of course, when we talk about Iranian barrels, its key buyers is actually China, which has been going through a period of poor demand. Now, of course, so a lot of these barrels, they are floating out at sea, but they're not unlocked for the wider markets. Then also the other development would be the additional 20% that has been, that according to Trump, that will be slapped on cargoes transiting out of the Strait of Hormuz. Of course, in his latest showing of wanting to exert control over, of course, over the straits. And that pales in comparison, of course, with the earlier fees proposed by the Iranian side. So essentially, ship owners are blindsided and they're taking a wait-and-see approach to see where things are going.
I suppose the question is, given you've already mentioned the lackluster demand out of China, what we've also seen in terms of OPEC plus policy as well, in addition to kind of the limited audience for these Iranian barrels, right? What does that mean for the broader oil price? We're back in those mid-80s. We haven't been here in about a month or so. Is there enough of a catalyst to push higher, 90, 100, or is this going to be a bit of a milder appreciation from here?
Right, Heidi. So if you just think back to just a couple of weeks ago, when the interim peace deal was signed, there have been talks of a potential glut or oversupply in the market has sort of resurfaced, and there was this window where a lot of Asian refiners that have been purchasing Middle Eastern crude coming out from the Gulf at highly discounted prices, China included, which is why it has sort of left some of these Iranian barrels in the lurch. And even though these deals are done with the way things are progressing at the Straits, it remains to be seen how these cargoes can be effectively loaded and transported out of the Gulf. And of course, there are other uncertainties as well, such as how US will plan to implement this 20% surcharge, which is of course going to drive oil prices much higher. And the market is still weighing to see how all this could actually translate to the physical markets, and that's something we have to keep an eye on for the next couple of weeks.
Our oil trading reporter Rongwei Neo there with the latest. And our next guest draws on more than 20 years' experience in the Royal Australian Navy, including leading multinational maritime operations in the Middle East. Jennifer Parker is now an adjunct fellow at UNSW Canberra. Jennifer, always great to chat with you. And in fact, we've been talking to you fairly frequently throughout the course of the last 1,000 days of this war. First of all, are you surprised that we're back here?
I guess I'm not surprised that we're back here in terms of the US attacking Iran and Iran attacking the US. I am surprised at how much Iran has continued to attack civilian shipping going through the Strait of Hormuz. The reason I say that is the MOU signed in mid-June. Look, there are a lot of holes in that were pointed out at the time, but it did have a lot of significant economic incentives for Iran. What we've learnt now is that those economic incentives are clearly not enough to allow Iran to give up the leverage that is control of the Strait of Hormuz. So I know this has been compared to the tit-for-tats that we saw during the ceasefire in April, where one side would strike each other and then there would be a response and we'd be in a lull. But I think the last week is something different. We're seeing this continued escalation since Monday last week. We've seen 6 ships struck in the Strait of Hormuz and the US reapplying that naval blockade. We are in a very different phase of this conflict.
The phase of this conflict and the calculus is interesting, right? Because at some points, various points throughout the course of the last few months, there's been suggestions that this is a much bigger strategic ambition for the US, that Washington is aiming to remove the instability in the region. At the start, we were even talking about regime change. We're not even talking about the nuclear ambitions anymore. This seems firmly focused on shipping through the Strait of Hormuz now.
Well, I think the commentary has been in the last week, but I think more broadly, I think that the key aim of the US is still about Iran's nuclear weapons program. I think that in the short term, though, the concern is around the Strait of Hormuz. And I think that really a lot of that relates to the fact that the US interpretation of the Memorandum of Understanding, which was fairly liberally drafted. I mean, it is quite hard to read, but their interpretation of Article 5 was that Iran was to not attack shipping in the Strait. They see what has occurred in the last week, which commenced Monday a week ago with Iran attacking a ship going through the transit route hugging the coast of Oman as a breach of that MOU. And the US, unlike in April when Iran was attacking ships, have decided that they need to disincentivize Iran. And the way they're going to do that is through punishment. So every time Iran attacks shipping, the US responds by attacking Iran. That is a different strategy. That is the deterrence by punishment strategy, as opposed to the economic incentive strategy we saw in the Memorandum of Understanding. But we did see this deterrence by punishment strategy in March, where we saw the intensity of the conflict. That was not particularly successful. The only way this is going to end is in negotiations. But the question is, how do we get a pathway back to negotiations when trust is so critically eroded?
Do you think this ultimately creates or lessens instability in the Gulf?
Well, look, I think that is an open question that only time will tell. It really depends on where this conflict settles. If this conflict settles with Iranian control over the Strait of Hormuz and a more emboldened Iranian regime, although clearly a weakened military, then I think that is more destabilising for the Middle East. If it settles with an Iranian regime that is significantly incentivized by economic relief, and we know that prior to this conflict, Iran was under a significant amount of economic pressure, and this is one of the things that led to the protests in December, January of this year. If that is the case, it could potentially result in a more stable Middle East, but I think that that is very much a glass half full view of things. Right now, the way things are heading, it does not look like we are going to end in a more stable Middle East anytime soon.
Jennifer, I wanted to get your views on this 20% toll that's being suggested by President Trump, right? We've got numerous people commenting on this within the industry. One shipping captain that we spoke to who asked not to be named, saying such a fee would be akin to highway robbery. This is pretty unusual, isn't it?
Look, it's extremely unusual. I don't think the US in any way, shape or form is going to be imposing a toll or any charges on ships going through the Strait of Hormuz. It's unfortunate that President Trump has said this, and of course the world is reacting to it, but I would put this down to significant bluster. Bluster that undermines the US position because, of course, the world is united against the fact that Iran should not be imposing tolls, and this has really undermined the US position. But moving forward, I can't see the US imposing tolls. It's certainly in contravention of international maritime law. It's also not practically achievable. I think this is unfortunate bluster. And this is a trend that we have seen through this conflict, where some of the lack of communications discipline, the political indiscipline around this conflict has undermined the US negotiating position and the US in terms of its relationship with its allies and partners. But I don't see the US imposing any toll. I do see the US reimposing their naval blockade on Iranian ports and Iranian coastal areas. That has been announced by CENTCOM, and that will come into force in the next 24 hours. But that is a very different proposition to this toll idea.
It's interesting. You mentioned the word discipline. I know that you've spoken about what you see as perceived lack of political discipline and perhaps strategic discipline from the president, right? Is he making the situation harder and extending this? And I guess maybe on the upside, do we see the Iranians also seeing this? Because it's interesting. It seems like these technical talks are still on foot for now. There's talk about potential compromise, even as we see this revival of this war. In this sense, do you see this as being fairly limited until a resolution comes when it comes to the Strait of Hormuz and doesn't sort of risk broadening out into a bigger regional conflict again?
Well, I think it is rapidly broadening into a bigger regional conflict. We've seen Iranian strikes across a range of Gulf states and strikes against Jordan. I guess when it comes to the communication strategy for the US, it's not entirely clear. I think the military strategy is clear, but the communication strategy and the strategic discipline, some people say that the strategy with Trump's communications is to create confusion, and in that confusion, the adversary or Iran is not quite clear on how the US will go, and that implies a deterrence, and that limits how they react. But that's not what we've seen during this conflict. I think that, and time will tell, and studies and analysis will tell, but my gut feel is that this lack of discipline around communications has extended this conflict and probably undermined some of the successful military gains that the US has achieved. Specifically, some of the terms that have been used by President Trump, also terms used by the Iranian regime, but we expect that by the Iranian regime. We don't expect it from a US president. Some of the words, some of the descriptions have turned allies and partners to have to criticize the US president at times during this conflict. And I think Iran has seen a vulnerability there, that some of this self-sabotaging language, and I would say the announcement of tolls, which won't happen, is self-sabotaging. They see this as a weakness in the US and perhaps an opportunity to prolong this conflict to get more out of the negotiations. Now, that's just a theory, but I think that this communication style is certainly not helping the US.
Jennifer, really great to have you with us. Jennifer Parker, Adjunct Fellow at UNSW Canberra. Still ahead this hour on Insight, we'll be bringing you the pulse check when it comes to what the markets are making of all of this. Oil, of course, climbing to the mid-80s. These renewed tensions in the Strait of Hormuz. Our tech shares also wavering. More weakness for SK Hynix, dragging that broader theme lower. This is Bloomberg. Welcome back. You're watching Insight, and we're watching these markets. A difficult session when it comes to what we're seeing at the moment. Of course, so much of this is being driven by these renewed attacks from the US and Iran, and we are seeing that broaden out into more of these Gulf region tussles as well. Brent crude now sitting at that mid-80s level. The question is whether that sort of diminishing demand from China, as well as the barrels already shipped from Iran during that brief window where they could, is going to balance out just how much we're going to see oil prices climbing. But certainly it does change the inflation outlook somewhat. Seeing New York traded crude also just under the $80 level mark. The other theme we're watching, of course, is tech. We're seeing that SK Hynix story dropping for a second day, and in fact following the almost 9% loss when it comes to the ADRs, pulling down that broader Kospi and tech sector, and that tech AI thematic as well, given how much of a rally we've seen so far this year. But let's bring in Garfield Reynolds to try and make sense of everything that we're watching. Our Markets Live Asia coverage leader here in Sydney with me. And what are you actually looking at the moment? Because obviously President Trump has said a bunch of things which may or may not happen, but overall this does potentially change the inflation outlook on a week where we do get commentary from Kevin Walsh, where we do get the inflation numbers out of the US as well.
Yeah, I mean, it should change that outlook. And I mean, I've been arguing that markets are already drastically underestimating the lingering inflation impact. When you look at break-evens, look at inflation swaps, they've all dropped right back ever since the Memorandum of Understanding was signed. That's despite, no, was it signed? I'm not really sure. I think it was. But the thing is, while crude prices came down a lot after that, the prices for fuels, which is the real world impact, they came down some, but nowhere near as far. So at the end of last week, we had, Brent was up about 20% on the year, but diesel and gasoline futures were up more like 50, 60%. So that's what you put in your car. You don't put crude oil in your car, so that's the inflation impact. And yet, inflation measures were showing expectations that inflation would come back under control very rapidly. So that means everybody was underestimating the impact of the war because they're focusing just on crude, which has some particular reasons, including what Ukraine's been doing in Russia, to come lower while the others are going higher. So this reset in the war is helping perhaps markets to realize the dangers, but it's still leaving us far less concerned across a range of assets than we should be about the long-term impact of these energy shocks.
Implications for treasuries and the dollar, does it just keep playing out the haven story?
Yeah, I mean, the dollar should keep rising. It is the haven of choice right now, both because the Fed is showing a greater willingness to be aggressive than many of its peers, also because of the what oil does to the dollar, what high commodity prices do to the dollar. So expect it to go higher. Treasuries also, they're at risk again. At the short end, they've got the risk that we get more rate hikes priced in sooner, and at the long end, you've got the risk of lingering inflation, as well as looming difficulties when it comes to how much issuance is coming. So all of that means, Treasury yields are likely to go up and take everybody else's yields with them.
Garfield Reynolds, who leads our Markets Live Asia coverage, just taking a look at some of the consternation facing investors at the moment. Still ahead, we've been talking about the dollar, largely range-bound ahead of the US inflation report, Fed Chairman Kevin Walsh's testimony to Congress. We've also got earnings season kicking off as well. Let's not forget that. HSBC's Chiu joins us next for her outlook when it comes to broader FX. This is Bloomberg. Welcome back. You're watching Insight. Let's take a quick look at the winners and losers when it comes to where these markets stand at the moment. Mainland Chinese markets are headed to lunch. Japan coming back online. Quite a bifurcation there. You can see where the winners are, and really is in that energy and commodity space, right? Brent crude, New York traded crude, seeing that jump, really holding those gains. Second day of advances for energy prices. That standoff between the US and Iran just intensifying. This, of course, flowing through to inflation concerns, boosting bets for rate hike concerns as well there. and we are seeing that downside when it comes to Asian stocks, particularly also being troubled by questions over this AI and chip-related sell-off. This is being dragged lower by SK Hynix in particular, and so after all, it was a challenging session on Monday, but the Wall Street session as well in the ADRs seeing a slump of 9.3% overnight. So that volatility for the Seoul-traded stock wiping out a gain of almost 5% earlier to fall by 5%. So this volatility that continues to grip the Korean markets is not fading anytime soon, particularly when it comes to Hynix and Samsung as well. We're watching the US dollar, which has been quite interesting. It is broadly still being played out as a safe haven, but in today's session, pretty range-bound, ahead of those inflation numbers in the US, ahead of commentary expected from Fed Chair Kevin Walsh there as well. We are seeing a little bit of weakness. A couple of standouts. The yuan is still being seen as cheap versus the euro, even after the recent gains. That's according to Deutsche Bank. It sees the Chinese currency has been undervalued by about 15% against the euro, which plays into the sort of trade basket side of things as well and the economic dynamics. We're also watching the Korean won, which has been gaining for a third day. Expectations that dollar inflows from SK Hynix's American depository receipts will enter the local FX market. So if that gives you an indication of just how big the impact of the trading debut was last week. Let's stay on FX. So Bloomberg Intelligence believes that the dollar's recent gains are likely to be short-lived amid further negative shocks due to the Iran war. Let's bring our Chief Emerging Markets FX strategist, Stephen Chiu. So Stephen, talk us through this in terms of what are the influencing factors that see the dollar either trading as a safe haven at a time of war, despite, of course, a war that is being instigated at the moment by the US, or falling out of favour in that sense?
Since the beginning of the year, there have been two phases when we talk about the US dollar. At the beginning of the year, when the Iran war broke out, it has been a safe haven. Just like the Chinese yuan, even better than the yen, it's the utmost safe haven. However, markets start to switch the focus from Iran to the Fed, especially when Walsh came along. Over the last month, it's pretty much about expectation of when will the Fed hike. Is it going to be July? Is it going to be September? Market has priced in that, and that continued to support the dollar. So going forward, it's a mixture of both. But we can see that even though whether we talk about Iran or we talk about the Fed, market is not reacting too strongly. That tells us that these two stories, these two factors are pretty much priced. We need a further escalation in Iran, things that we can't really imagine. We need a really hawkish pricing. Now market pricing a hike or two over the next few months. We need 2 to 3 or even 3 to 4 hikes being priced to keep the dollar strong. So the bar is getting higher and higher for the dollar strength to continue. So from a strategist perspective, if you ask me, in the second half of the year, the best bet is sell dollar on rally, if that's possible.
What about the winners and losers in the EM space, Brad? It's really interesting looking at the kind of more idiosyncratic stories for the yuan, for the won as well. Do these currencies necessarily depend on dollar weakness to continue rallying?
If you ask me if you want to stay dollar neutral, if you don't want to bet on the direction, the best place to be, it's still the Chinese yuan and the safe havens, namely Hong Kong dollar and the Sing dollar. So these currency might not be the best performer when the US dollar weakens, but it can hedge against various scenarios. So what if we are wrong? The Fed has to hike 3 times, the dollar strengthens. These few currencies will still be strong. China, structurally, still very positive. And now the policymakers, they have the incentive to globalize the currency to support a stronger yuan, even with a strong dollar. Sing dollar, we know the MAS has an appreciation bias. So despite the strong US dollar, Sing dollar can play well. Hong Kong dollar, of course, last but not least, has the dollar peg. So these 3 currencies will play out nicely regardless of the dollar trend.
Stephen, always great to have you with us. Stephen Chiu, Bloomberg Intelligence Chief Emerging Markets FX Strategist there. Let's get some more on these currency markets. Joey Chiu, who's a head of Asia FX Research at HSBC. So, Joey, of course, I want to go back to the dollar because all roads lead back to the dollar and where it's headed now. Are you convinced that this dollar bullishness, the safe haven trade, can continue?
Well, actually, it's really interesting to just hear Stephen's view about the dollar. I think a lot of people also think that the dollar, the positioning the dollar is a little bit stretched at the moment. And when they see how the dollar is failing to really gain that much traction from this renewed escalation, they wonder if the dollar is already fully priced in. So our view is actually that, the dollar is in the new range. The DXY is in the new range. We see it as 100 and 105. And then we see it sort of grinding higher within this range. It's not explosive like 2022, but is also in a new uptrend that we see now.
The inflation concerns are building, right? And we are expecting to get some more numbers as well as commentary from the new Fed chair. How much do you think the uncertainty, the escalation, re-escalation when it comes to the war is going to change the outlook for inflation and therefore the expectations of what the Fed will have to do?
I believe that the Fed is actually really focused on the second round effects or on the underlying measures of inflation that have already been quite strong even before the war, through the war, and possibly going into the second half of the year. So for us, we are watching core CPI, core PCE very carefully. There have been a couple of speakers from the Fed talking about, say, core PCE or core CPI being above 0.2% on average month on month for the rest of the year, because that will indicate sticky, non-core price pressures. I think that is exactly what we are focusing on for tonight as well as the next few prints. If that is the case, then I think it'll be very hard for any of the Fed speakers, including the Fed governor himself, to deny that inflation actually remains quite resilient, quite strong in the US.
Do you see that we see a more reactive dollar when it comes to yield moves as well?
Yeah, I think in the last year, maybe even in the first quarter of this year, the dollar's relationship with a lot of underlying variables just sort of broke down, right? There was a lot of headline noise. There was a lot of this narrative about de-dollarization, and that sort of created this breakdown in the relationship of the dollar with its underlying variables. But this kind of relationship is actually coming back. We see it coming back with yield differentials. We see it coming back even with risk appetite. Sometimes this idea of U.S. exceptionalism potentially taking place again. So I think the data is just going to be more important for the dollar going forward, which is why the Fed speakers potentially giving less forward guidance is also important in that extent, because it just makes us focus more on the data.
We are seeing some moves when it comes to Japanese bond futures, JGB futures extending the gain after the 20-year debt auction. They're selling 169 billion yen of bonds in the first non-competitive sale. The lowest price, 20-year bond bids being accepted at the lowest price there as well. There's been a lot of movement and excitement in JGBs and by extension the yen with this idea of potential GPIF rebalancing, what the government is trying to push forward. It's not a new theme, but it's sort of been, I guess, crystallized a little bit more in the last few days or so. Do you see this as having a meaningful implication for the yen, or is that really going to have to require the BOJ to be a lot less timid than it has been?
Well, definitely the BOJ's the rate decisions is going to be super important for the yen. But I think we cannot deny that capital flow measures or capital flows in general are just very important as well. And we see that before in 2013, 2014, right, when the Abenomics led to a lot of changes in capital flow, including GPIF's launch into foreign asset allocation. So this time around, it's possible that we also could get some kind of potential partial reversal of what we saw in 2013. Things are still too early to say, but suffice to say that it is definitely worth watching, because GPIF's AUM is so large that even 1% point change is 20 billion worth US dollars worth of capital flow changes. So all these are quite large and worth paying attention to.
Joey, where do you see the biggest winners and losers within Asia? Clearly, we've got another reignition of potentially higher oil prices, higher energy import costs. But at the moment, we're seeing a pretty strong case for the yuan. We're also seeing a kind of a turnaround for the won as well.
Yeah, for us, look, When we think about Asia themes, we think about the Fed and the dollar. We think about oil prices. And then we also think about a third theme, which is, the winners and losers about this whole semiconductors terms of trade, right? Because semiconductor prices have risen a lot, and that has benefited some of the, exporters like Korea, Taiwan, even Malaysia, Singapore, but then not so much in a lot of South Asian countries. So when we consider all three things, we actually think that Thai baht could be a little bit on the losing end or a little bit on the back foot, right? So we see Thai baht underperformance. So we do like a long dollar Thai baht. And then on the opposite side, as you were saying, on the winner's side, we think RMB will remain quite resilient, but the interest rate differential against the dollar is a bit of a hurdle for people to go directly bullish on RMB versus the dollar. So for RMB, we prefer to think about its outperformance on a basket basis, and we still like it against euro.
How much do you like it against the euro? How much undervaluation do you see there against the euro?
When we consider that the CFETS index is already back to early 2025 levels, people think that, there's not that much room for CFETS to rise. However, even if you subscribe to that view, you can look within the CFETS basket performance and see that actually RMB has outperformed the dollar, the Korean won, the yen, but it has still underperformed the euro as well as many other European currencies. So even from this perspective, without considering further appreciation in the index itself, you can still get further RMB outperformance against the euro. Not to mention that from a structural perspective, if you consider the trade surplus, etc., the RMB is quite cheap against the euro from that perspective.
So much for India is tied to the fate of crude prices, right? And certainly with this reignition of the conflict and oil prices jumping again, it's not looking good. Is it difficult to see any other outcome for the rupee?
Actually, the 5th June FX package by both, the Indian government with the tax incentives as well as the RBI with the FCNR package, I think all these tailwinds are still building, right? The FCNR deposits are still gathering pace. They will be in place for the next, the entire third quarter. So I think, it's still early days yet when it comes to these tailwinds for the INR. Of course, the headwinds coming from oil prices is very untimely, but overall we see dollar INR, remaining in this range that it has been at and potentially grinding lower within this range, dollar INR, if we do get this respite in the, Middle East tensions.
When it comes to, we spoke a little bit about the won, but I am curious, there seems to be this expectation that the repatriation story from SK Hynix, the ADRs in the US, as well as that broader sort of macroeconomic impact of the AI and chip rally is going to continue boosting the currency. Is that being overshadowed by some of the bearish factors that have been more of the headlines when it comes to the won?
When it comes to the won, I would just say that the gross flows on either side, be it outflows or inflows, are incredibly large, right? The outflows are coming from, potentially foreign investors taking profit on their Kospi investments. So these remain very large because the valuation gains is just enormous since the start of the year. But on the other hand, we also have Korea potentially finally being able to benefit from this very large current account surplus that they are now having, right? It's annualizing at 300 billion per year. That's 20% of GDP. And if you think about, some of the Korean won deliverables that they might have, a lot of these companies, is to do with compensation, it's to do with dividends, it's to do with tax payments. A lot of this could potentially materialize in the third quarter as well as first quarter next year. So I think to that extent, there are some expectations that, even after this ADR listing, there could still be some tailwinds for the Korean won. But of course, as we mentioned, right, it's both sides of the flows are just so large. It's incredibly volatile.
Joey, really appreciate your time with us today. Joey Chiu is the head of Asia FX research at HSBC. Still ahead, India's inflation topping the RBI's target for the first time in 17 months. Our next guest says it may not be enough to force the RBI's hand. Garima Kapoor of Elara Securities joins us next with her outlook. This is Bloomberg. Welcome back. You're watching Insight, and take a look at the market open in India as we had those inflation numbers coming in. Will they be enough to prompt any sort of panic from the RBI? This is the picture as we see Sensex as we head into the trading day. 0.6% lower is that last traded price. We have the Nifty oscillating sort of around that 0.5% level there as well. We have seen the return of foreign stocks, though, foreign buyers, I should say, into this market. It has been providing some support. One of the stocks that we are watching, HCL Tech, of course, big earnings week, particularly with the IT giants that have been under so much pressure. The company first quarter net income beating estimates, but still not really helping much with investor sentiment for the broader sector there. But in the meantime, that inflation number is what we're looking at today. June consumer inflation print accelerated to 4.38% from 3.93% in May. That CPI figure topping the Reserve Bank's target for the first time in 17 months. Food inflation in particular, a 5.3% rise compared to a 4.8% gain in May. Higher crude prices, obviously, they're fueling inflation and will continue to fuel inflation, one would imagine, given this re-escalation of the conflict and what's going on with the Strait of Hormuz at the moment. The trade deficit, in the meantime, is also worth noting, widening to a 5-month high of $30.4 billion in June. That was in excess of economists' forecasts as well. Total imports dropped to just under $71 billion from $73 billion. That was dragged lower by oil and gold imports. Let's bring in now Garima Kapoor, who's the Deputy Head of Research and Economist at Institutional Equities, Elara Securities India. Garima, really great to have you with us. So let's start off with the inflation reading. Is it enough to stir some concerns from the RBI and see any kind of policy response?
Hi, good morning. While the headline inflation print did cross RBI's midterm target, which is 4%, I do not think we are in a panic mode yet. If you stripe out the volatile food, fuel, and precious metal components, the core, which we call as a super core inflation, is well and below 3% and actually at 2.5%. That kind of indicates that while there are inflationary pressures building up, because there is a pass-through of fuel inflation, the inflationary pressures are not yet broad-based. Until and unless RBI sees a sign of entrenched inflation expectations, I do not see RBI responding with a rate hike to these numbers.
For how long can they see through the price pressures? Does this depend on where we see commodity prices and oil prices headed from here if this re-escalation in the US-Iran war continues or worsens?
Yes, the re-escalation of the US-Iran conflict is a apparent concern. But if you notice a broad basket of commodities, before the re-escalation started, the correction in commodity basket was very swift. You almost saw the Bloomberg commodity index go back to its level which was before the war. So we kind of understanding that the commodity pressures, X of conflict ignition, they're broadly sober, or they are well behaved, and they're not really worried. As such, I do believe that till such time inflation crosses 6%, which is RBI's upper tolerance limit, and stays there for a foreseeable future, I do not see RBI hiking rates. For a broad average for entire financial year 27, we should actually anticipate the CPI inflation to be below 5% versus RBI's number of 5.1%. We're looking at that number to be at least 20 basis points below RBI's estimates. So far now in our numbers, we're not projecting any rate hike from the RBI.
What does that mean for the rupee?
See, unless and until Fed responds with a rate hike, today's CPI numbers in US are very crucial. Of course, recent commentary from Fed chair has been kind of indicating that hawkish backdrop is developing in US monetary policy for sure. So there are certain headwinds that are developing for the rupee. Dollar is nearly at a 1-year high. You are not yet beginning to see the benefits of FCNRB inflow develop and to reflect in the rupee. And more importantly, RBI has a short forward book of more than $100 billion. It cannot roll all of it, so it needs to run some of it down. So I do believe rupee will trade in the broad range of 94 to 96. With an intermittent short taking it above 96 for sure. So I'm not very positive on a broad appreciation for the rupee. I do believe where it's trading right now, it's where it should continue to trade in the near term.
rainfall has been uneven, right, in terms of the rainfall deficit and how that's playing the other part of the inflation picture for food inflation. Do you expect that could potentially worsen?
So we started off with a very heavy deficit of more than 40% in the month of June. The July rains have been welcoming. The deficit has come down by about 20%. But going forward, we'll need to watch out for the intertemporal and spatial distribution of rainfall. A spike in food prices remains a key risk to monitor for sure. But the good part is that global food prices are not soaring, number one. And number two, the government of India has ample stocks of key cereals, including rice and wheat. So its ability to respond to elevated food shocks is much superior than it was in the past. So I will watch out and monitor the upcoming trends in food prices. But as of now, I don't think we need to press the panic button.
What about trade? We had the trade numbers out as well. And we've also seen Narendra Modi just conclude this trip to Indonesia, I should say, to New Zealand and Australia, with some trade agreements and talks being chief among the deliverables. Do you think some of those trade agreements can offset the tensions between India and the US on trade?
The trade agreements, the most important trade agreement which will go on floor and get executed is the India and UK agreement, which will get executed towards the end of July. But remember, in terms of quantum of share in India's trade basket, US is the most important player. So while US accounts more than 22% of India's goods export, UK is very below at about 3 to 4%. So while these trade agreements will help India to diversify, any further headwind that comes in form of tariffs, either because of the solution or resolution of Section 301, or what happens to tariffs after the July 24 deadline of reciprocal tariff of 10% passes, will be one critical headwind to watch out for. But yes, if I look at the basket of India's exports to US and non-US territory versus Jan 2025, while exports to US have fallen by 3%, the exports to the rest of the world, excluding US, have increased by 9%. So diversification is certainly helping, but I would still say that it's very critical for India to be able to resolve its trade negotiations with the US sometime soon.
Very quickly, how much pressure is there then if the Fed goes ahead and tightens?
If the Fed tightens, it is very difficult for an emerging market currency which has $100 billion worth of short forward book not to be able to tighten. So I do believe if Fed responds with a rate hike sometime in the coming foreseeable few months, I do believe RBI's hands will get tight and the degrees of freedom will reduce. RBI would have to respond with the rate hike to at least ensure that the interest differentials do not really go out of whack.
Garima Kapoor, Deputy Head of Research and Economist, Institutional Equities at Elara Securities India. Really great to have you with us. IDBI Bank is one stock that we're watching in terms of seeing a move to the upside at the moment. In fact, we're seeing that rise of 3.3% or so, paring back, but at one point that was the most since July 2nd there. This, as we hear that India's government is close to saying yes to an offer from Fairfax Financial Holdings for IDBI, possibly at a slightly higher price there. This as we see the government exploring ways to revive interest from potential buyers for a majority stake in the bank after efforts hit a snag. Well, that is just about it for Inside Horizons. Middle East and Africa is up next. Do keep it here with us. This is Bloomberg.